Thousands of Niyo users stranded abroad without access to their money. The problem, however, wasn't with Niyo, but the bank underneath, the first love of all fintechs, the State Bank of Mauritius. How did this bank just spring up all around us? What exactly is SBM's strategy? Welcome, I'm your host for the week, Pranav. Without much further ado, let's dive a little deeper and answer all of these questions. Nestled in the Indian Ocean, Mauritius may be known for its stunning beaches, but in the business world, it's renowned as a tax haven. And at the heart of this hub is the State Bank of Mauritius, the second largest bank on the island. With roots dating back to 1973, SBM has expanded its reach across the globe, including India, Kenya, and Madagascar. In 2018, SBM made its mark in India by converting its operations into SBM Bank India, the country's first universal bank accredited by the RBI through the wholly owned subsidiary model. This meant that the bank was now a legal entity registered in India and held to the same standards as a domestic bank. If you'd like to skip over to the Niyo Fiasco, jump over to this chapter. Now, back to breaking the jargon about the foreign bank types. Foreign banks operate in India via the branch licensing model. But post the 2008 crisis, RBI came up with a new wholly owned subsidiary model. So in this setup, the bank is expected to register a separate legal entity in India and operate like any other individual domestic bank, thereby bringing them and their respective balance sheet under complete scrutiny of the RBI. The idea was to tighten the governance of foreign banks to protect Indians from any potential downfall of the parent bank in another country like the Lehman Brothers back in 2008. While branch licensing for domestic and wholly owned subsidiary banks has been liberalized, allowing them to freely open branches in the country, foreign banks collectively are given only 15 to 20 branch licenses in a year, thereby limiting their growth potentials. But most foreign banks such as HSBC, Standard Chartered, Citibank and more have not adopted this model, simply to be able to leverage the volume of their parent company's balance sheet to give out bigger ticket loans in India. And also on another note, over 70% of our viewers don't seem to subscribe to our channel. It is free and you can always unsubscribe if you don't relate to the content. Let's now talk a little about SBM. The bank has interestingly chosen a non-traditional way to grow by becoming a digital, asset-light financial marketplace. This approach has earned the bank a reputation as the fintech's first love. With 44 plus partnerships under its belt, including Slice, LazyPay and Niyo, SBM has been able to double its assets under management in financial year 2022 to 8,000 crores and has also grown its loan book by 50% to 4,000 crores, all while operating profitably in the past 2 years. We also covered the whole story of how Slice used an ingenious technique to provide their credit cards until RBI came in and quashed the whole construct. Click on the link at the top to watch that video. First, let us understand a little about Niyo. Founded in 2015, Niyo has been offering a suite of digital banking solutions via prepaid cards, cross-border travel cards, and more. It was among the first neobank before the term was even popular. With over 6 million users on board, it has predominantly gained prominence in the recent times thanks to its extremely popular product, Niyo Global Card, an international travel card with zero forex markup fees. Guess which bank enabled this card for them? Of course, none other than SBM. SBM's relationship with Niyo has been deeply impacted since the RBI directed the bank to stop all international transactions due to material supervisory concerns. RBI did not indulge into any further details, but as a result, Niyo, Vested Finance and other SBM-backed cross-border fintechs faced temporary restrictions, leaving thousands of Indians abroad without access to their funds. RBI partially relaxed the restrictions post corrective actions from the bank, but the relief is only temporary. This has been a second big blow to the bank since the Slice episode. If it will be able to keep up with the regulations and sustain the growth, only time will tell. And that's it from us. Hope you learned something valuable today. If you did, don't forget to hit that like and subscribe button for more startup related value content. And until next time.